Hello, welcome to Geojit Spotlight. Welcome back to this learning series on mutual fund investments. In this episode, we will examine the returns from various investments like bank deposits, public provident fund, gold, and the stock market, and try to understand which investments, which asset classes give superior returns in the long run. All investors want to maximize returns and minimize risks. That's the objective of all investors. However, the risk varies from people to people. It depends on a large number of factors like age, income, wealth, expenditure commitments, liabilities, etc. Age is a very important factor. If a person is young, the income is very high, expenditure commitments and liabilities are not very high, wealth also is very high. In that case, that person's risk appetite, ability to take risk will be high. On the other hand, if a person is old, the income also is low, and there are some expenditure commitments, and in such a scenario, the risk appetite of that person will be very low. Also, psychology is a very important factor. Some people are by nature risk-taking. Some are by nature risk-averse. So these are the factors that determine the risk appetite of persons. Now, as a general principle, we can say that risk and returns are positively correlated. That is, as risk increases, returns also increase. Similarly, lower the risk, lower the returns. Generally, high risk assets like stocks and stock-based, equity-based mutual funds like equity mutual funds and hybrid funds deliver superior returns, but they are risky. On the other hand, investments in bank deposits, public provident fund, and debt instruments are less risky, and therefore their returns also are low. But a very important point to understand is that this risk in stock investment and equity-based mutual funds is high only in the short run. Actually, in the long run, there is no risk at all. This will be very clear if you look at the performance of various asset classes over long periods of time. So look at this table. This table gives the returns from assets like public provident fund, fixed deposits, gold, silver, and the stock market. For the stock market, we have taken the benchmark Sensex. We have taken Sensex, not Nifty, because we are going back to 30 years of returns. Nifty was not there 30 years ago. And we have also shown in the last column inflation to understand which asset class beats inflation in the long run. It is very clear from this table that the stock market, as measured by the Sensex, has beaten all other asset classes in the long run. 3-year return, 5-year, going up to 30 years, you can see the returns from Sensex, and this is much superior to returns from PPF, FD, gold, and silver. I'm not reading out the figures. It is self-explanatory. You can observe that. Now, there are 3 important conclusions that we can derive from this table. The 3 conclusions are, number 1, the Sensex has beaten all other asset classes by a decent margin in the long run. If you take 3 years, 5 years, 10 years, going up to 30 years. Second conclusion is gold is second to Sensex in returns in the long run. And the third conclusion is that Sensex has beaten inflation by a decent margin in all these time periods. So the conclusion is very obvious. And the point I want to stress is that the superior returns are available only in the long run. If your time horizon is 1 year or 2 years, this kind of outperformance will not be available. During a 1-year time period, the return can be 0 or even negative. Even for a 2-year time period, the return can be very low. This happens over a long time period, a minimum of 3 years or 4 years and above, ideally. Now, I gave the example of Sensex returns. Now, individual investors can beat the Sensex returns, or they can even underperform the Sensex returns. Depends on how good an investor the person is. Good investors beat the Sensex returns. Poor investors, a large number of retail investors who dabble in low quality stocks do not get Sensex returns. So that depends on the individual and the individual's expertise. But if you are opting for the mutual fund route, instead of investing in stocks directly, if you are investing through the mutual funds can certainly beat benchmark indices in the long run again. So the returns from mutual funds, if you take the last 5 years, 10 years, 20 years, 30 years, are superior to, the average returns from mutual funds are superior to the benchmark returns. So that makes mutual fund investments an ideal investment route.